Exercise 610 asks us to do some journal transactions for a company that uses perpetual inventory. Just remember that perpetual inventory means when you buy goods, you increase your inventory account. When you sell goods, you reduce your inventory account. So you keep your inventory numbers current. So on July 5th, we purchased 40 televisions at $2,500 each. That was our purchase. So that's $100,000. So our inventory comes in at $100,000 and our accounts payable $100,000. Our terms are 310 net 30. Which means if we pay in 10 days, we get a 3% discount. If not, we have to pay the whole thing in 30 days. Then it tells us that we return 2 televisions that are bad. So we're returning 2 televisions at $2,500 each. So we reduce our accounts payable. We debit our accounts payable by the $5,000. And we reduce our inventory by $5,000. Remember, perpetual inventory, we're keeping our inventory current. Now on July 13th, within the 10 days, it's not the 15th, it's the 13th, so we're entitled to our 3% discount. We're going to pay our $95,000, but because we paid it in time, we don't have to pay the full $95,000. We get a 3% discount of $2,850. So our $2,850 discount reduces what we have to pay. So our cash that goes out is $92,150. But this $2,850 means we paid $2,850 less for our inventory, so we credit the inventory for $2,850 to indicate that the value of the inventory has gone down by the amount of the discount taken. Then on the last day of the transaction, we sold the remaining 38 televisions for $3,000 each. So we sell 38 televisions times $3,000 each, and 38 times 3 is $114,000. And remember, because this is perpetual inventory, we have to do 2 journal entries for a sale, not just one. So we have $114,000 in accounts receivable and $114,000 in revenue, but we also have to take the $92,150, because that's what we paid for these televisions. We have to take that out of our inventory and debit our cost of goods sold. So cost of goods sold, $92,150. Inventory credit reduce $92,150. I'm going to go through and just talk about the numbers, make sure you got them all. We bought 40 televisions at $250 at $2,500 each. That's $100,000. These were our terms. We sent back 2 televisions at $2,500 each. That's $5,000. That reduces our accounts payable and it reduces our inventory. Now on the 13th, 8 days later, well within the 10-day period, we send them a check. So our accounts payable goes down for the full $95,000, but because we got the discount, we don't have to pay the full $95,000. We only have to pay 97% of it, $92,150, and the 3% discount reduces our inventory. Then on the 28th, we sold the remaining 38 televisions. 38 times 3,000, 114,000. Our accounts receivable goes up. Our sales revenue also goes up. Our cost of goods sold is a debit. It goes up. It's an increase to our expense. And our inventory goes down. Perpetual inventory, keep track of the inventory as you go along.